Hi guys, Mark Franke here, and today we're going to look at Chapter 21. I'm going to use Problem 21-3B and 21-4B, which are on page 863 and 864 of your textbook. So, we're going to start by just talking about planning. We just went through the planning, the master plan, and this chapter is focused on a different type of planning called flexible budgeting, and we'll also do some standard costing stuff. So this is very specific to a manufacturing environment where you are anticipating different levels of production. So this first problem, 21-3B, the first thing we need to always do is separate out the fixed cost and the variable cost. So we're going to do that first. And they gave us some numbers based on production levels, 15,000 units. So we spent 22,500 on indirect materials, 90,000 on indirect labor. Indirect materials would be shop supplies or solder, sometimes paint, stain, small fasteners, screws, nuts, bolts, those kinds of things where it's really difficult to keep track of individual little parts. So we throw them into an indirect material category and they just get applied based on some application rate like we talked about in the overhead chapters. So if we total this up, we get total variable cost of 180,000 at the level of production of 15,000 units. So if we divide the dollars by 15,000 units in each one of these categories, we'll get the per unit cost of that particular item. So our variable cost per unit just for overhead, this doesn't include direct materials, this doesn't include direct labor, we're only focused on overhead here. So that's $12 per unit, and then fixed cost, we want those to be based on time. We don't want them to be, that's what they are. We're usually talking about a monthly rate or an annual rate, something that's tied to the calendar and not based on the volume. So in this case, we have 180,000 in both fixed and variable overhead. So 360 is the total. So now we can prepare a flexible budget based on this information. So this is the Suncoast company, and we're going to call this a flexible overhead budget. This is just overhead, and this is for the month ended December 31, and we'll say 2019. Okay, and what we're going to do is we are going to make a budget based on 3 different levels of production. And we're going to use the per unit amounts for the variable cost, and we're going to use the total amounts for the fixed costs. Oops, I started too high, sorry. Let's do this again. So we're going to use the per unit amounts for the variable costs at these 3 levels of production. And of course, it's $12 each. And then we're going to use the totals for the month based on the fixed amounts. So we already know that at the $15,000 level, it's going to be $180,000 in fixed cost, because that's how we got these numbers to begin with. So let's just bring those over here. But now we need to scale it back oops. Okay, so there's our 15,000. It's got to be the same as these numbers over on the left because that's how we got started. So I'm going to stop the video and I'm going to build a flexible budget for 13,017 minutes and then come back and show you the answer. So what you could do is pause the video now, see if you can calculate these amounts, and then continue on. I'll be right back. Okay, so through the magic of video, these are the numbers for the production level 13,000. Again, I multiplied the number of units times the per unit amount for variable cost. The fixed did not change based on different levels of production. So that's a flexible budget. The reason we do this is because if we don't know exactly what level of production we're going to be operating under, because things change and sometimes demand may go way up or it may drop off, and so we have a relevant range. What that means is we have a range of production that we have typically operated under. If we look back for a couple of years, well, we've never been under 13,000 units and we've never been over 17,000, so that provides a range, and in effect we can make a budget for different levels of production. Okay, so now we have a flexible budget at different levels of production, and they gave us actual results. So we are going to compare what actually happened to our plan, our budget, so we can make sense of why things were different than we expected them to be. This is the way we manage financial information in a business, is we prepare a plan, this is what we think is going to happen, and then we compare that to what actually happened, and then try to figure out why things are different. So requirement 3 and 4 focus on direct materials and direct labor. Direct materials and direct labor. This is based on a standard price, and the standard price that they've given us is 4.5 pounds at $6 per pound. So if we operated at 15,000 units, we're going to take 15,000 units times 4.5 to get the total number of pounds. And I'll make a notation of that out here. This is 15,000 units times 4.5 pounds per unit. That's how I got that 67,500. and our standard price is $6. So we expect to use 67,500 pounds, and we expect to pay $6 per pound. So that means that if we make 15,000 units, we expect to spend $405,000. So what we actually spent, and this is given in the book, they said we spent 69,000 pounds. We paid $6.10. So what we actually spent is $420,900. So that went through the general ledger when we paid the vendor and did the things that we do. So now, in order to do the analysis, I'm going to bring the actual quantity. That's what we actually used. You can see that we used more than we expected, and we paid more than we expected. So when I take the standard price and multiply it times the actual quantity, that gives us a total of 414,000. And if we subtract what we actually used times the standard price, that will tell us that we have an unfavorable variance because we spent 10 cents more than we expected. Then, if we focus on the quantity, we also have an unfavorable variance because we used 1,500 pounds more than we expected to use. And that's also unfavorable. So the total variance is unfavorable. We have pulled apart the quantity and price components of this material. Whatever it is, it comes in the pound. And we have an unfavorable variance, meaning that we spent more on materials, direct materials, but not only did we use more than we expected, we paid a little more than we expected. So that's why both of these are unfavorable. We can do the same thing with labor. Here's the labor variances. So they told us that we actually spent 22,800 hours at a rate of $2.30 per hour. So we actually spent $280,440. Our standard is, again, 15,000 units times 1.5 hours per unit. And our standard rate is $270,000. Our standard rate is $12 per hour, which is a total of $270,000. So the 22,500, again, just like with the materials, it's 15,000 units times 1.5 hours. That's our standard number of hours. We expected to spend 22,500 hours to make 15,000 units, and we expected to pay $12 per hour to our labor, to our employees. So again, if I bring over the 22,800 hours, and if I bring over the rate from the standard column, which is $12, then I can calculate the variance. So the variance between what we actually spent and our standard rate, we spent $6,840 more. And if we take actual hours times the standard rate, oh, I got a bad cell, let's try this again. We also have an unfavorable variance, and our total variance is unfavorable. We spent more on labor than we expected to because we used more hours and we had to pay a higher rate. So that's why both the rate and efficiency variance are unfavorable. The total variance is unfavorable. So that's the direct materials and direct labor piece of this. So what we now can do is an overall overhead variance report. Again, Suncoast Company. This is an overhead variance report. And for the month ended December 31, 2019. And because we operated at 75% of capacity, which is 15,000 units, we're going to use the flexible budget from the middle column, which is 15,000 units. So I will populate that, and I'll be right back. This came right from the middle column of our flexible budget we did in requirement 1 and 2, this middle column right here. And so now we're going to drop in the actual numbers. This is what we actually spent during the month. For each one of these types of overhead costs. So overall, we're under our flexible budget, and we can calculate these categories. And what I'm going to do is take actual and subtract the flexible budget, which means that if we're under, if we spent less than what we expected, that's a favorable variance. And if we spent more, that's an unfavorable variance. So overall, though, we had a favorable variance for the variable overhead costs. For the fixed costs, same thing. Take what we actually spent subtract our plan, and if the number is positive, that's an unfavorable variance. That means we spent more than we expected. And so overall, sorry, this is wrong. We had a favorable variance. Our plan said we should spend $360,000 on overhead, and we spent $355,000, and that is less. That's favorable. And then each category has its favorable or unfavorable. For building depreciation and supervision, we spent exactly what the plan said, so there is no variance. We are comparing what actually happened to what our plan told us we expect to happen. So let's do one more practice on the standard cost. This is problem 21-4B. And here we're going to use the information to calculate first our direct material variance. So this is 24B, this is page 864. We have 1,000,000 pounds is what we used, and it was $4.25 per pound. So we spent $4,250,000. Okay, so now calculating our standard quantity, standard price. This is given to you in the book. It's $1,050,000 times $4. So what we expected to spend is $4.2 million. What we actually spent was $4.25 million, which means that we have overall an unfavorable variance. However, the reason we have a variance is because we paid $4.25 a pound instead of $4. So we have an unfavorable price variance. We spent 25 cents more and times 1,000,000 pounds, and then we saved money on the quantity. So we have a favorable variance because of the quantity. We expected to use 1,050,000 pounds, and we only used 1,000,000 pounds. So when we combine these two variances, we have an overall unfavorable variance. But we saved money. We saved money on the quantity, but we paid more per pound. Looking at the direct labor, the actual labor was 250,000 hours. And we paid $7.75 per hour. So what we actually spent on direct labor was $1,937,000. Our standard was 252,000 hours. And our standard price was $8 per hour. So we expected to pay $2,016,000. Oh, sorry, I unfortunately copied some arrows. Okay. Which means if we bring over what we actually spent in hours times our standard rate, we'll see that we saved money. We have a $62,500 favorable variance. And we also had an efficiency variance because we expected to spend 252,000 hours and we actually spent 250,000 hours. So we saved money because we used less hours, and we saved money because we got a cheaper rate. So both variances, the rate variance and the efficiency variance, are favorable. And then our last analysis is the overhead variances. These are just given to you in the book, but we'll schedule them out. This is the $1,960,000 plus the $1,200,000. That was what we actually spent on overhead. What we expected to spend, is $3,276,000. And when we subtract, we get a favorable variance. What we actually spent is less than what we expected to spend. So that's a favorable variance. And on the fixed, the overhead controllable variance is based really on the variable cost. This is based on the fixed cost. The budgeted fixed overhead was 2016, and the fixed overhead applied was $1,764,000. So we have a volume variance that is unfavorable. Our volume did not come up to the expectation for the month. So that's a complete variance analysis on our three product costs: the direct materials, the direct labor, and the factory overhead. Thanks for watching. I'll see you again next time.